Now that you know all about the indexes, it's time to get into the deeper internals. We'll go over 4 different internals that can be used for day trading or swing trading. All these internals give valid information about volatility, volume, and the battle between the bulls and the bears. The link to my charts for Thinkorswim with all of these internals are in the link below. So get those opened up if you have Thinkorswim. I'm going to personally be using TradingView to view these things, but let's go over them. The first internal goes side by side with the index. This is called beta, and that is a simple number between 0 and 100, but it's usually between 0.5 and 5. Beta is how much movement the stock will have or has had compared to the general markets. Because SPY is basically the general markets, it has a beta of 1. So a stock that has a beta less than 1 would mean it moves less than the general markets. A stock with a beta of 1 means it will likely move identically to the general markets. So you might as well just trade the general market indexes if you're trading a stock that has a beta of 1. And a stock with a beta over 1 means it is more volatile than the general markets. The beta number can always change as volatility could increase and decrease at any given time. For example, Tesla had a large beta of over 2 before they did their stock split. That means Tesla was moving 2 times more than the general markets. After the stock split, Tesla calmed down a little bit and was about a 1.3 beta, which means it is still more volatile than the general markets, but only by about 30%. Second is one of the most valuable internals, and that is the TICKS. This might be named differently depending on your broker. On Thinkorswim, you have to have a $sign before the tick. The ticks are an index that measure the amount of upticks subtracted by downticks in the general market. In general, over 1,000 ticks is a very strong uptick reading. Under -1,000 is a very strong downtick reading. If the ticks are between 600 and 100, this is somewhat of a strong uptick. So this could be a strong market. And between -600 and -100, this is somewhat strong downticks. If the ticks are consistently above 600, this is a really strong market. But if they are consistently below -600, it's a pretty strong downtick and a pretty weak market. And obviously, if the ticks hang around 0, it's a neutral type of battle between the bulls and the bears. Some traders will even put a 20 SMA or EMA on the tick readings to get an idea of the strength of the ticks. Let's go over a couple examples of reading the ticks. First is a sudden spike in the ticks. This is usually not a time to react to the single tick movement alone. It's important to note where the ticks were sitting before the spike. If the ticks have been hanging out on the more positive side, then suddenly drop down below -1,000, what you want to see are the ticks to bounce back up and hold over 500 or 600 for some time. But if the sticks start to hang out lower now after that spike, that might indicate a bigger downtrend for the markets in general. The third internal is the ADD, which is the advanced decline. The advanced decline is calculated by taking the number of stocks that have advanced subtracted by the number of stocks that have declined over a certain time frame. Most traders use this internal more as a convergence divergence type of internal. For example, if the ADD is going up, but SPY or the Qs are all falling, then a trader might see the ADD as predicting a reversal in SPY. The fourth internal is called the PCALL or PVCA, which I think of it as the market short squeeze internal. The PCALL is the put to call ratio, which has to do with options. In other words, it's a ratio of the sellers versus the buyers. When the number is over 0.9, it's a decent number of sellers. And over 1, there is a significant number of sellers. And when it is under 0.5, there is a decent amount of buyers. And under 0.35, there is a significant number of buyers. Anywhere in between isn't really much of an indication. When looking at the P-call, you have to think about the idea that 90% of traders fail. So when everyone is getting short, that's usually when you should be buying. And when everyone is long, you should probably be selling. Well, that is mostly how this indicator works. When the P-call is over 1, then there are a lot of shorts. So as soon as the shorts start to lose, they will have to get out. This will cause a short squeeze in the markets as a whole, causing a large rally in the general markets. The opposite can occur if the P-call ratio is really low, meaning a lot of people are long and markets start to fall. Then there are a lot of people long that are hurting and may have to start stopping out and maybe start panicking, causing an even larger drop. It is also important to take into account the general trend of the markets at the time of the P-call ratio. If markets are falling hard and the P-call is over 1, that doesn't mean blindly buy everything, but is simply an internal to help you get more conviction in addition to other indicators and internals. In summary, think of the internals like a weather channel, forecasting what is to come. It's not 100% right all the time, but could for sure help you get an idea if you should be putting a jacket on or not. I suggest you keep an eye on all the indexes mentioned and keep an eye on these internals to get an idea of how they all work and how they move with the markets. They are especially important for the mid to large cap stocks. The general markets and special internals like TICKS won't affect the smaller momentum type of stocks nearly as much. There are more internals that exist, and I may have to add them to the section later. But for now, let me know if you have any questions about these internals, and I'll see you in the next video.